I'm going to just spend a couple of minutes talking about investment trusts in general before I move on to talk about Witan Investment Trust in particular, because I think this has been a very interesting period for the investment trust industry. This is the third year that I presented here at the Master Investor Show, and I've heard some fabulously interesting presentations from all kinds of companies, some of which I'm sure will be wonderful investments for you as individuals and indeed for people that have been here in previous years. To my mind, the investment trust structure is just a wonderful structure for long-term investment into a vast array of asset classes, whether it's global equities like Witan, or individual countries or sectors, or even more esoteric assets. But it is fair to say that, like the other great British institution, the last year or so has been an annus horribilis for investment trusts, and discounts moved from close to asset value to 17% on average at one stage. They have narrowed in a little bit recently, and you might wonder why that is. Well, I think there are various things that have happened. Interest rates went up, so competition for capital, valuations on equities were more stretched when discount rates are higher. People were able to invest in other alternatives. Talking about alternatives, there were lots of issuance of new investment trusts that caused a bit of indigestion in the market. So those are a couple of factors. And in fact, a couple of those new issues have grabbed the headlines for the wrong reasons. So that's also been a bit of a headwind for the sector. But really, the institution itself, the investment trust institution, is over 150 years old. Witan is over 100 years old, and this year we celebrate our 100th anniversary of listing on the London Stock Exchange. So, weathering those storms, if you like, is very much in the DNA of the investment trust industry and of Witan itself. So, with that said, let's move on to talking about Witan Investment Trust and what it is that we try to deliver to our shareholders. Witan is an unusual investment trust in that it is self-managed. That means that we don't have an asset management company that is responsible for a vast array of different fund products. Witan is an investment company. We have one fund, and that is Witan. Myself and my colleagues are employed by Witan, so our shareholders are our employers, which also makes us unusual. And of course, we're directly responsible to them. The board of directors, I think a couple of them are here today, so working overtime on a Saturday, provide all the oversight that is necessary in running an investment trust. They set the strategy, and really it's they who look after the interests of our shareholders. We in the investment team, the board delegate much of the day-to-day management to us in the investment team, and we're the ones who pick our multi-managers. So Witan is a global equity investment company run on a multi-manager basis. That means that we have 7 or 8 different portfolio managers to whom we allocate bits of our portfolio according to their own areas of specialist expertise, and we blend those managers together to produce a global equity portfolio that we think is fit for the long term. It's important to differentiate between what we do and a fund of funds, because our assets are held in our custody, in our account, so we can see every day, or even during the day, what's going on in our portfolio. It gives us an incredible amount of information about how our managers respond to a changing environment around the world. It also gives us this risk management and oversight, including ESG integration, that enables us to best look after the long-term interests of our shareholders. In terms of what we're trying to achieve, it's long-term growth in capital and an income growing ahead of inflation over the long run. And so there you can see it's all in one picture. You've got the board of directors delegating responsibility, day-to-day responsibility to us in the investment team and our portfolio managers. You put that together and you end up with a portfolio which is 1.7 billion of assets, 8 different external managers. Between them, they own about 250 companies. I won't go through all the numbers. They're all there on the screen. But you can see very diversified across all the sectors of the world. And we also have some investments in some specialist funds, which I'll come on to. Now, you might think, oh, God, 250 companies, that's a massive number of companies. And how can you possibly benefit from the the active management that your managers are there to deliver? Well, our active share, which is a measure of how different you are from your benchmark, is 79%. 100% is you're completely different, and 0 being you're exactly the same. In other words, you're an index tracker. So we're quite different from our benchmark, and we believe that that's the way to approach active management. The way we think about our portfolio, bearing in mind this is one portfolio, I talk about different managers and their portfolios, but it is one portfolio that a Witan investor buys into. In fact, someone said to me earlier, what's the minimum investment? Well, the minimum investment in Witan is £2.42, or at least it was on Friday, the price of one share. So here we are, we've got our core portfolio, which is about 75% of assets. This is primarily invested in large and mega cap companies throughout the developed markets. We've got 6 managers responsible for picking those stocks. Some of those names I'm sure you will know. I won't go through them in huge detail, but I will be very happy to answer questions. One or two that you might not know, Jennison up here on the left are an American-based manager investing in very high growth companies where they look for a positively inflecting growth rate. That means these are not just companies that are growing, but they're companies that are growing, increasingly growing their earnings. And another one down here, WCM, they're also based in the US, and they look for high quality businesses with a strong corporate culture and an expanding economic moat. One other I'll point out is Lansdowne Partners, UK-based manager, highly adaptable. They will give us exposure from time. A few years ago, they owned a lot of the US tech companies. Today, they're much more interested in the value that's available in some of the capital-intensive businesses here in the UK and in Europe. And then we have a specialist portfolio because we believe that, yes, there are fabulous opportunities in the developed markets of the world in big companies, but also there are lots of opportunities elsewhere. So the specialist portfolio, which is invested by us as the investment team, that's the Witan slice there, into specialist funds, and I'll go into more detail on these. And we also have an investment with GQG Partners, which is an emerging market manager, and GMO, which is a strategy that looks to benefit financially from efforts to mitigate or adapt to climate change. So what does that look like in reality? Well, here are just some examples of the 250 companies within the portfolio. There are about 200 companies in the core portfolio here, and all of those that you can see the logo there on the screen are in the top 20 holdings of Witan's portfolio. So some of the darlings of the moment, NVIDIA, Microsoft, Amazon, and then some pretty unloved companies as well. Let's face it, AIB, the Irish bank, BP, Unilever's been a bit out of favor as well. So the managers are looking at some of these opportunities and saying, okay, so life has been a bit tough for some of these companies. But for example, with some of the banks that the managers own, and I think I heard this being said earlier actually, their returns to shareholders, or the amount of money they're returning to shareholders on an annual basis is staggering. 20% in some cases, which is the combination of dividends paid and shares bought back. So whilst the growth might not be there at the same rate that you will see in some of the technology companies, these are very, in our view, very cheap assets which are undervalued. Then the specialist portfolio over here, I'll come around this side. Specialist portfolio, you've got some emerging market companies like ICICI Bank, Taiwan Semiconductor Manufacturing, and then one or two specialist funds. Apex Partners is a private equity house, Syncona, a life sciences business. God, time flies, I'm halfway through already. Portfolio breakdown, just I won't pause for too long on this, but what you can see is a very broad split across sectors around the world. And in terms of geography, we've got about 40% of the assets invested in the US, which is underweight relative to our benchmark. Our benchmark is about 50% US, because the collection of our managers are finding greater opportunities in Europe and the UK versus the US. In fact, the European number there, 22, is about 10% more than our benchmark. So you can see that's where the money's gone that isn't invested in the US. I'm a bit careful about using these terms value and growth. They're very convenient shorthand, but no stock is a value stock or a growth stock. Hopefully they're a combination of both. But we've got roughly, as you can see here, about half of the portfolio invested in each type of company, which we believe gives investors a a sort of decent spread of risk, not only in terms of geography, sector, but also in terms of style. You can see there's a chunk here, the blue chunk across all three of those. That's investment companies. And I started this talk talking about investment companies and saying what a tough time it's been for them. So let's have a look and see what we own within that segment of the portfolio. It's about 11% of Witan's overall portfolio. Predominantly, it is invested about 50% in private equity. I must stress that these are typically not venture cap, kind of early stage, very highly rated, cross your fingers and hope for a fantastic result in a year's time or a few years' time. These tend to be sort of mid-sized operating companies where cash flows and profits are positive. So we believe that although they're private companies, they behave in a way like listed companies. So, and here we've listed the discount at which these funds trade. I mean, these are enormous numbers. We bought into Harvest this time last year at a 50% discount to asset value. It's now a 40%, so that's positive. But I think there's a long way to go. And then the two other names there, 30% discount to asset value as well. Syncona is one I'd like to point out as well. This is a life sciences company based here in the UK. They back early stage drug development and take those companies through to maturity. There's an awful lot of cash on the balance sheet of that company, of that fund. So it says it's on a 30% discount, but actually the discount to the companies it owns is much closer to 70 or even 80%. I won't go through all these in detail. I'm happy to answer questions. The only one I will actually point out is VH Global Sustainable Energy Opportunities. The renewable energy sector within the investment trust sector has gone through a terrible time. This is different because it's not a energy generating business like a lot of the solar and wind funds. This develops projects. So we see this as a capital upside as well as potential for income growth. And again, trading on a significant discount to asset value. As an investment company, and I have heard this already said today, so hopefully I'm just reinforcing the message, we have other levers we can pull to help generate additional returns, hopefully. Gearing is one that is one of the sort of secret weapons of the investment trust structure. Being of the size that we are, 1.7 billion sterling, we were able to negotiate very favorable terms for our fixed rate borrowings that we use to gear the trust. So, for example, where it says long-term fixed rate there, our bonds, or actually they're private placement notes, which are issued to insurance companies and pension funds, are dated from 2035 to 2054, so very long term, average yield of 3%, which is, frankly, 1.5% cheaper than the UK government is borrowing at. So we think that's a benefit to our shareholders. Long-term equity returns are 7, 8% in general. So if we can borrow at 3 and invest at 7 and 8, that's not a guarantee by any means. We think that's advantageous. Like many investment trusts, our shares are currently trading at a discount to asset value, close to 10%, which is much wider than we would like it. So we buy shares back. It helps to reduce the volatility of the share price. It helps to, and when you buy shares at a discount to asset value, it provides an uplift to the NAV for the remaining shareholders. So we think it's positive for shareholders. And being a self-managed investment company, we don't earn a management fee. I mean, we're obviously employed by Witan and we're paid a salary, but we don't earn a management fee. So there's no kind of conflict of interest there. So we'll buy shares back if we think it's in the right, in the interest of shareholders, rather than in the interest of anyone else. We can use ETFs and occasionally derivatives. I don't want to overstress derivatives because it's a very small part of what we do, and it's only very occasionally. Because when we look at the combination of our manager portfolios, we might see that there are opportunities that they are perhaps missing out on, or there's something, a dislocation in the market that we think is a short-term opportunity. So we can use ETFs and sometimes derivatives to fill in that gap and hopefully take advantage of a short-term dislocation in the market. And here you can see the impact of this gearing that we apply. And generally, the impact is positive. Obviously, in years of positive market returns, it's a benefit. In years of negative, it's not. But generally, it's been positive over the last 10 years. And you can see that gradually the cost of that debt has declined. It increased last year because the short-term variable rate borrowings that we have, which are a bit more flexible than the fixed borrowings, were obviously more expensive as interest rates went up. And dividends. We are an AIC dividend hero, which I forgot what the definition is now. I think it's 20 years of unbroken dividend increases. You can see from 1975, I can't claim credit for that, because in 1975 I was in short trousers. But 1975 through to 2023 actually, we increased the dividend every year, and with a dividend growth rate of 7.7% over the last decade. I mean, it's a well-known benefit of the investment trust structure that we can retain previous year earnings in revenue reserve to help smooth dividends over time. And you can really see this impact here in the COVID period. This green line is the dividends paid out by the FTSE All-Share. So our dividend has grown at a significantly faster rate than the FTSE All-Share. But also, that was a 25% decline in the payout of all-share companies during COVID. Some forced by regulator, some forced because obviously earnings disappeared. But we were still able to continue to grow our dividend using reserves. We have a responsible investment policy. We believe that investing in good companies that behave well or are on a journey to improvement, so this is not necessarily buying into companies that are already whiter than white. It's about buying into companies that are good businesses, that are well managed, that recognize some of the challenges that we face as a society. And the two that we really highlight are climate change and a change in social expectations. So if we can help those companies to improve their behavior over time, that will lead through to more dependable performance and earnings at the corporate level, and therefore feed through to our shareholders. And that is our purpose. Our purpose is to achieve significant growth in investor wealth over the long run. You can see that it's not always a straight line. And COVID here was a tough time, as was the point in the cycle where interest rates started rising. But that shows the performance since the start of the multi-manager structure, which was in 2004 through to today. Patience has rewarded the long-term investor. And I'm going to finish there, leaving some time for questions, just with the chart showing the discount at which our shares trade to net asset value. You can see over here, in the period 2013 to 2016, we were trading at 2014 to 2016, we were trading at a premium to asset value, so we were able to issue shares to buyers to meet demand. And that was a sale. There was a sale by a large institutional shareholder, which impacted the discount. We bought back a lot of those shares, and you can see the discount narrowed over time. But we haven't been immune to the widening of the discount across the investment trust sector, which is the pink line here. We obviously factor that into our decision when we're thinking about buying shares back, but it doesn't drive our decision. So, we think that at a 10% discount to asset value, that's a fabulous opportunity for our shareholders, and so we'll continue to buy shares back. And I'll stop there.